Kenyan shilling was steady with one eye on the crisis in Egypt, and traders said it could weaken in the coming sessions as importers buy dollars to pay for their routine end-of-month shipments. Now, for more on the performance of the shilling, I'm joined by Solomon Ulubala, who's the head of Treasury at the National Bank of Kenya. Solomon, thank you so much for joining us today. I just want to get straight into it, looking at the 91 Treasury bill. We've seen it dip to probably one of the lowest level, the fastest fall that we've seen in the past 2 months. Have we reached the ceiling?
Actually, if you go back to March, you will see that the TB rates were at these levels. We've basically gone back to these levels. This follows the initial stance by central bank to ease the rates, where we saw a cut in the CBR rate to 8.5%. And I think this was a bit too aggressive. We saw the TB rates go to as low as below 7%. But what we are seeing is a correction. But from the recent auctions, if you look at the rise, is actually very minimal. It's been rising by about 10 basis points, but the 91-day Treasury bill has now come down from 10.48 to 10.46. That signals the intention of central bank to actually curb the rise in interest rates.
Now let's talk about the central bank right now that has actually accepted more than they needed in terms of the Treasury bills, 4.1 billion that they accepted for the bids, when actually all they needed was 3 billion. Why did they take out more than was needed?
If you look at it, we had the 10-year auction, the 10-year bond. We also had the 2-year bond, and now we've had the 91-day T-bill. Now, if you look at the 10-year bond, actually central bank rejected all the bids. That was a clear signal about the rates. And on the 91-day, what has happened is basically the picking of the shilling is, to them, is a fairly better rate. So what central bank is trying to signal is they're trying to manage the rates on the long term.
There's a lot of liquidity in the market that we're seeing right now, and usually in this situation you would have the central bank come in and pull away this liquidity, so to speak. So why has it not done so?
What has happened is we saw last week and the previous weeks there was a lot of liquidity strain in the market. It was clear that the market actually was dry, and central bank came in reverse repo, where they pumped in about 18 billion. So basically, it's just a balancing act at the moment. We are in a situation whereby I think the devolution is taking a bit of time, and the government is not spending as much. And this was putting pressure on the interest rates. But the central bank is more keen in containing these at these levels. Actually, if you look at it, there was a big rise from where we were in July up to where we are currently, from as low as 6.75% to a high of 10 and above. So that signals that the rise was actually very sharp.
Do you see this having an impact on the shilling at all?
Yes, I think the impact will be felt on the capital inflows, because what we've seen over the past few months has been that at these levels we're seeing a lot of capital inflows coming in from the foreign investments, and that is supporting the shilling. So if we have rates at these attractive levels, then you'll see capital inflows which will basically support the shilling.
Now let's talk about some of the event risks that we've seen, the unrest that's currently in Egypt. Seeing that Kenya is such a, in terms of its exports to Egypt, I mean, that should obviously have an impact on the shilling.
Generally speaking, it should have a negative impact on the shilling, because our exports should be affected. But what has happened is we've seen a situation whereby the exports have actually not been drastically affected by what's happening in Egypt. In fact, the demand for tea in Egypt is still stable. But what we need to watch at the moment is the overall current deficit, because what's happening is currently the deficit has not changed. The situation is still the same as it was last year, and that's a worrying point. So based on the current account deficit, then we will see the shilling actually depreciate towards the levels of 89. What would support it would be actually the expected Eurobond to be floated by the government. That's one thing to look at, and the short-term capital flows that we're actually seeing, and perhaps increase in foreign direct investments.